We've got one final financial crisis ahead of us, which will crunch all prices, including gold and silver, less so gold, more so silver. And after that, we should be on the path in a beeline to the end game. That has been my thesis at the endgame investor since the 2020 financial crisis caused by, let us not speak of it ever. The last time we had a golden cross of the blue line above the red line, we had a 10-year bull market up to the 2011 highs. And this is different now because you can see here that gold and stocks have been pretty much in pace since around 2018, but gold has not outperformed stocks since then. But if it does, and people realize that their portfolios are losing relative to gold, they're going to pile into gold and into silver, and it's going to supercharge the rally that we've already been in.
In the 21st century, gold has beat out stocks. The average compounded return for gold from 2002 to 2024 is 10.0%, while the S&P 500 index has returned only 8% a year, including dividends. Financial journalist Rafi Farber points out the occurrence of the weekly golden cross in the gold-to-S&P 500 ratio, perhaps leading to a decade-long bull market in gold. He suggests that if gold starts to outperform stocks again, it could increase investment in gold and silver. A new report from the firm's portfolio strategy research team forecasts that the S&P 500 would see an annualized nominal return of 3% over the next 10 years. That would put it in the 7th percentile of performance since 1930. Goldman data showed that it would also badly lag the 13% annualized figure put up by the benchmark index over the prior decade. Technically, Rafi also notes the current silver premiums, which are low but not negative, suggesting a healthy market. Farber predicts that in a financial crisis, premiums for physical silver could spike significantly, similar to what was observed in 2020. The surge in the Shanghai silver premium underscores the growing importance of the Chinese market in shaping global silver dynamics. As China's demand for silver continues to rise, it is likely to significantly influence silver prices and availability worldwide. Examining recent developments, Rafi Farber mentions an unexpected outcome following a 50 basis point rate cut by the Federal Reserve as long-term treasuries have declined in value rather than risen. This anomaly has led to consistent weekly losses for the Fed, estimated at $2 billion since February 2024. In our view, the Federal Reserve easing cycle is still at an early stage, with 100 basis points of cuts expected in total this year, and another 100 basis points in 2025. Gold has historically rallied by as much as 10% in the 6 months after the first Fed cut, according to the World Gold Council. Now we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We have the first weekly golden cross in the gold to S&P ratio since 2001, excluding the 2020 crisis over here, which brought gold to S&P up wildly because gold went down not very much and stocks crashed. So that, I think, is artificial because of what was done to the economy. I'm not going to count that. So the last time we had a golden cross of the blue line above the red line, we had a 10-year bull market up to the 2011 highs. And this is different now because you can see here that gold and stocks have been pretty much in pace since around 2018, but gold has not outperformed stocks since then. But if it does, and people realize that their portfolios are losing relative to gold, they're going to pile into gold and into silver, and it's going to supercharge the rally that we've already been in. We're not quite there in the silver to S&P 500 ratio, but we're getting close. You can see here 0.0052 versus 0.0058 where we are now. You can see here I zoomed in on the gold to S&P 500 ratio. You can see that they are exactly the same. 0.4411, 50-week moving average, 0.4411, 200-week moving average. And yes, this is magic. Everything in finance is magic. Premiums are low in silver, but they're not below zero. I marked the zero line. We could be worried possibly that premiums are so low. But they're around what they were before silver squeeze started in 2021. But you can see here that they were below zero in 2010 and 2011 a lot of that time. So if the physical price is below the spot price in silver, the futures price, that means we're in a little bit of a silver bubble, but we're not seeing that here. Premiums remain low, but they are at 5.5%. It just means that the spot market is ahead of the physical market, and the physical market will catch up, I believe, on a financial crisis, which will happen in the repo markets. You'll see that premiums will spike just like they did over here in 2020, and I think they'll go a lot higher than they did back then. This I wanted to show you that the rate cut, 50 basis point rate cut, has not slowed Federal Reserve losses. You would expect that they might, because if they cut rates, then treasuries will rise in value. Well, they haven't been rising in value. That's been pretty strange. I think this is the first time that a 50 basis point cut has not raised the value of long-term treasuries. They've actually fallen as long-term rates continue to rise, and since that is what the Fed holds, their losses continue. You can see their weekly losses are about between $1 and $2 billion a week, and it's been pretty consistent throughout the year. Since around February 2024, it's been that much losses per week, and it continues.
In a recent analysis, Rafi Farber explains the implications of the repo to reserves ratio, emphasizing its predictive power regarding upcoming financial crises. He notes that while the current ratio is 64%, a return to 83% could signal a looming repo crisis within weeks or months. Some analysts have theorized that this bullish force will end when reverse repo reaches zero. The latest data show that the New York Fed is holding just $202.8 billion of them, down from a high of $2.4 trillion in 2022. But the Fed can always go back to doing regular repurchase agreements if the Fed wants to keep pushing money into the system. Rising RRPS are bearish, but rising repo agreements are bullish. The Fed did a lot of regular repos during the 2000s, especially during 2008, before yanking the chair away just before the 2008 elections. Concurrently, Farber anticipates that reverse repos may drop to zero by November, which could precipitate a rapid decline in bank reserves and trigger a crisis similar to September 2019. Let's get back to the interview.
It is the repos to reserves plus reverse repos ratio. So repos to parentheses reserves plus reverse repos ratio. I want to see how much overnight loans are being made relative to the total supply of dollars available, which includes not just bank reserves, but add reverse repos to that. So here on September 18th, 2019, that was the Repocalypse, 83.13%. Usually I just show this ratio as a repos to reserves, repos to bank reserves ratio. Now I'm adding reverse repos into it to show the total liquidity. I think this is a little bit more accurate as to where we are on the timing for this next crisis. So we have here September 18th, 2019, 83.13%, and we are now at 64%. As of October 23rd, 2024. Once we hit 83%, we're going to have a repo crisis somewhere around there. Not exactly. It could be a little high, a little bit lower than that, something around there. How much longer do we have? Hard to tell, but it's not years. It's weeks to months. We'll see how far we get in the next few weeks as reverse repos finally drop out. But here is why I think that reverse repos are finally going to go to zero by November. It's this chart. What I want to show you here is, look, we're at October 25th right now. So $202.798 billion in reverse repos left. And what you have here is you can see typically from mid-month until the end of the month, we've been having a rise in reverse repos. In September, it was pretty strong. September 16th at $239 billion to the end of the month, September 30th at $465 billion. So that was about a doubling, almost a doubling of the reverse repos in the second half of September. We had the same thing over here, starting from around August 15th, mid-month, until the end of the month. August 30th, we also saw a rise in reverse repos. We had the same thing over here from mid-June to the end of June, a big rise and then a plummet. We had 1 month where we did not have a rise in reverse repos in the second half of the month, and that was in July. So you see here we had 413 over here, and then we had still 413, so it was very stable. It was 100% stable from July 15th to July 30th, 413 billion. And then we had the plummet, right, to a low of 286 billion by August 7th. So that is 413 billion to 286 billion. That's about 130 billion or something like that, 127 billion, if I'm not mistaken. I'm doing the math in my head. So now we have this situation like we had in July where we do not have a spiking reverse repos into the second half of the month. So what I'm saying is that we could be in a situation where we're about $130 billion below where we are now, which is 200 billion. That leaves about 70 billion left because in July it dropped 127, 130 billion from where it was around the mid-month. It could be, 100 billion, 70 billion, something like that. It's going to be very low, and then we should zero out. And once we do that, bank reserves are going to start to fall very fast, and we're going to have a repo crisis.
Gold's nominal price followed a similar long-term pattern, resolving with a breakout to new all-time highs last year. As an extension of this forecast, Goldman also sees stocks struggling to outperform other assets over the next 10 years. How should investors interpret the Golden Cross as a signal for their strategies in the gold and silver markets? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.